Hey traders, Nick Shaheen here, recapping the week with regards to levels. Every week, in the beginning of the week and then throughout the week, I update daily. I put out levels that I basically read the tea leaves with regards to open interest and decide as to where the ranges are likely to be for the week. This helps active traders trade the market and manage your positions regardless of the style of trading they do. For me, it's credit spreads. Other people is debit spreads, and some people is just actually chasing tickers. So chasing is a key word. Sometimes the level tells me not to chase at a certain point if it's coming up against my forecasted resistance level, for example, until it proves to me that it can actually break through it. So here are a few of the tickers that we look at. I'm going to start with the SPY, the SPY right here, and I put up 10 days or so. So let's see here. The week is, this was Friday, so this is where the week starts on Monday right here. Oh, let's concentrate on the week. And in the beginning of the week, the statement was that the support starts at 204, that was far from being tested. So let's talk about resistance. On the SPY, we said that the resistance is small resistance as 206, much bigger at 207, and even bigger at 208. And I said small bumps higher than 208 this week. So 206 got tested, so the 207 and 208 overnight. The peak yesterday after the close, we had the strange spike in the S&P, which was a little weird, but anyway, regardless, the close was 207, right in the middle, where I said that the resistance would be much stronger at 207. So 207 was the line, and the close was thereabouts, 207.20 or something like that. The lines are never hard lines. Sometimes they work out, but it's more like a rubber band. Meaning what? Meaning if going into the week I know that the higher end, the stronger resistance is at 208, I wouldn't sell the 208 credit call spread. For me, some people would. For me, I don't. I like to fight from a little further out. So this is the S&P. So I wouldn't sell the 208. I would go up higher and build a buffer, 1, 2, 3%, whatever I can still get premium, and sell it out there. If it's running up against 208 and I know this is going to be a resistance, do I chase it? No, I'll wait to see how it's going to behave. So knowing that 208 is going to be strong resistance, it will stop me from chasing. It will stop me from backing down on a position I have open. It will stop me it will help me make decisions on however I'm trading in the market. So that's number one. The level held up on the S&P as far as SPY is concerned, and the SPX will probably be the same story. Let's pull it up right here. SPX, I said, this is again the start of the week, so let's make blind before that, so make it easy. I said obviously anything higher than 235 to 245 was resistance, meaning the S&P was already in resistance territory. That doesn't mean it's going to fall. It just means that any movement up, I actually said that any movement higher, in theory, the bulls would need a reason to run. And they did run, but not on many reasons. And there's that poke, that strange poke overnight. And the open today was, telling that it let it go of it. They tried to run it up again, and then they broke down. So I said basically the 2055 to 2075 stronger resistances. Each line was a much stronger resistance. So I said, in theory, they would need a reason to run higher. So the idea of chasing would have stopped if I knew this information as it got higher through to 2055 and 2075. The close was at 2067.5, so right in the middle of that range, and 2075 held as the upper end of the resistance. There was more resistance higher, so but you can only cover so many levels, right? So what happened on the Qs? The Qs was the most enthusiastic of all the indices this week for sure, and that's the Nasdaq, obviously. On the Qs, I said 104 is start of resistance, and 104.5 was a small bump as far as resistance is concerned, and it gets stronger at 105. gets stronger at 105, and then I said 106 looks twice as strong as far as resistance is concerned, and then nothing until 107. So what happened today, this week? Again, this is the week started here. Let's make it blind. So we busted through all the resistances and then failed at the 106. Again, that was a strange peak right there. The 106 looks twice as strong, so it failed at that and closed just under 106. Still an enthusiastic close, but the levels held. So it helps guide the trading. Lastly, as far as indices are concerned, we have the small caps. This is the IWM, and again, I'm going to just show this week. Excuse me, but pollen counts are high in California right now, so a little allergies kicking in. Support starts at 117, so basically it had a base from which it can ride. So it was not much resistance until 118, so there's room for it to run up rather than run down because it has decent support behind it. So credit put spreads were the way to play that thing. So I said 115 should hold this week, so credit put spreads are the best way to play it. And the 115 definitely held. Obviously, we didn't test them that hardly today, maybe a little bit at 116. But the resistance levels, not much resistance until 118. So it was a little murky, not a lot of good resistance levels on the upside. I said another line of defense was in 119 as well. But nothing else was clear, so it was definitely to be played as a credit put spread rather than a credit call spread, and it did play out nicely. It did close at 117 or 116 and change, so it was right there in the sweet spot. No major moves to the upside, even though it had the room, but it wasn't tested heavily on the downside either. So that's the IWM. What about the RUT? Sometimes it's a little easier to play with the RUT, which is also the small caps, only 10 times bigger. And sometimes the 4s bigger premiums and wider ranges. On the RUT, the call on Monday, this is all Monday before the open. I said 1180 and 1185 are start of resistances, much stronger at 1190. And there were a couple of positions open at 1210, 1220, somebody's bet that went sour. It was in good size too. It was, dwarfed everything else, unless it was a tandem play with some stocks that they benefit. Otherwise, it looks like it was a loser trade in my opinion, regardless of how you slice it. So regardless, the RUT looked pretty strong for a little bit. Went to 1192 early a couple of days ago. But then today did not perform well at all, down 1.5% just about. So overall the week was a meh, a push, but the levels definitely held. 1191 tested the upper end of resistance and then said, you know what, I'm not willing or able to go through that resistance line, so I'll listen to Nick and I'll drop a little bit. I wish, and drop a little bit. So they closed at 1173, which is lower than the resistances that we had. Again, they had support, good support levels, and they were willing to, they would have rewarded credit put spreads rather than credit call spreads. I had a credit call spread in order and it got tested, and I didn't close it because I knew of the resistance levels, and I was leery of it because of the 1210 level that were open and somebody's opinion of exuberance. However, I was watching for signs and the signs never came. So that line held as well. So IWM, RUT, triple Qs, even though got tested hard, SPX and SPY levels held nicely. So what about individual equities? So here's Apple. And Apple is the trickiest these days because last couple of weeks I've been running up against resistances and not looking at it. So I'll, for giggles, I'll look at it. I said resistance starts at 116, then gets stronger in 17, 18, 19, and 20. Obvious, stating the obvious. So it's a waste of time. I said don't short it via credit call spread. It's a waste of time. I don't have enough conviction to go along it. So again, it tested all of the resistances, and now it looks like they want to trip up at the 120. They got short of it, and now they're shy about it. Well, let's see how long the shyness lasts. I'm out of it until then. So the level there, even though it wasn't a hard, definite win for us, the win part is that we didn't play it because I didn't have enough intelligence on it. So know my limitations and trade accordingly. Alibaba, Again, I said if I wanted to go anything on Alibaba, I'll go longer term long positions on it. So either debit call spread, I can finance them with some credit put spreads. No clear lines of support in the morning of before the morning on Monday. I said from the open interest resistance starts at 110, and sure enough, it tried to rally through 115 but then fell almost to 110 again today. So the resistance levels were hard. I updated the resistance level later on today before the open, and 113 was the clear line of resistance, and that's where it failed today. So it's still, even Alibaba with all of the momentum, it still, missed the resistance level by $1. That's 1%, yes, but then again, I said, it's rubber bands, and I said don't do credit call spreads with that guy. So on every big fall, I would probably do a credit put spread to finance some debit call spreads to build a position long, like longer dated calls, in the money calls, out in next year or even 2016 calls. How about the Goog? I like the company. It got challenged hard theoretically this week by the EU also raining on its parade. So it shrugged it off, and this morning they tried to sell it right here. That's the candle probably where the first day of trading in the US for after the EU announcement, because it came on the day where the US was closed yesterday, Thanksgiving, and then crawled right back and closed even better than Apple, up 0.3%. This is the Goog. Same thing for the Goog L, just a little bit higher in dollars. So the Goog, I said, still a lot of resistance on the Google this week, 540, 545. I said 545 and 550 look very resistive. That's from Monday before the open. So credit call spread should work again. This is every week now, 3-4 weeks in a row. Small support at 530, then better support at 525. So let's see, 530, 535 was the low of the week. So the support held for Google on every challenge, and the resistance also held. So if you played an iron condor based on these levels, you made money for Google, regardless of what you use. This was the Goog. You could have played it just as well with the Goog L, only a little bit higher in dollars. So all the levels held, even with all the violence and the uncertainty and the movements and the over exuberance and the markets at all-time highs and the Nasdaq running like there's no tomorrow. So the levels still hold up. Well, what does that mean? It means let's back up and trade the ranges and ignore the noise from the market. And as long as you just know what you're trading and know your levels and know where you stand with regards to your levels, like here, this is an all-time high, and now we're consolidating. Are we consolidating to go up a little bit more? Are we consolidating to breathe a little bit like here? I don't expect a whoosh all the way down without a major headline. Conversely, I don't expect a whoosh all the way up without another headline. Headline downwards, plenty. Choose whatever you want. Japan, China, anything you want. ECB saying no QE. Conversely, there are only a handful of things that can make us explode higher. Mainly, right now, the closest is a QE, and most likely candidate is ECB. We've had two giant pops, and they were QE from China most recently, and a little older, QE from Japan. They both unexpected. So who else is left? Next at bat is Eurozone, the whole thing. So that's where I stand with the levels. Until then, I'm comfortable taking some shorts and taking some longs to hedge some of those shorts. Other than that, I can't chase the hoopla and, like, for example, GoPro. You just can't trade that bad boy. And I did a write-up, especially on GoPro. You can play it on the long side, or you can argue, okay, it's trying to take out the blue line up here, and once it does, it's going to retake or challenge the 95s. Or conversely, it may work its way back to 72.5 and break the blue line on the downside. And if so, that's my favorite scenario. Well, I favor that scenario over the other, but it all depends on the market. And if that happens, the mid 50s are still not out of the question. So trade what you're seeing and trade the ranges that you've got, as opposed to sentiment and what the experts say on TV. Nick Shaheen signing off.